The first chart I'll open up is the chart of Bitcoin. Now, you saw massive volatility coming in on Friday in the US market. In Bitcoin, you saw price plummeting from 122 to something like 112. Even today, it's trading at 112.37. The volatility is just not over. There were also a lot of reports on X that one day prior to the announcement by President Trump, there were a lot of new accounts that were opened up and net short positions were created. You also have to understand this is a script we have seen play out in the month of April, May as well, where first the news comes in. Before that, a lot of short positions is taken. Then the prices plummet. Then somebody buys. The inner circle is always there. And then the counter news comes in and price again starts to rally. So this is nothing but part of volatility that has been there in this year. And I think for the next 3 years, the way certain leaders are functioning, this is going to be part and parcel of the market. And that is why you don't have to pay too much attention to short-term news, short-term volatility. Of course, those people will be impacted the most who are short-term speculators. Now, why Bitcoin moved so much or the entire crypto market moved so much? Even if you open up the chart of Ethereum, look at the massive volatility right from 50 DMA. The rejection happened from 4362, price went down to something like 3456. I'm talking in one particular session. See, you have to understand in stock markets or crypto markets or any other market, leverage amplifies direction. Wherever there is greed, there will be leverage. Now, I still feel Indian markets are going to hold out relatively well. That was the theme of my last video, and I still stand by it. So first, you have to understand what actually happened in the crypto market and why the correction then spread to the equity market. Yes, the news flow was not great. President Trump again was threatening with 100% tariff. I don't know whether that has been imposed or not, and more stricter measures on China. That is what led to dampening of sentiments, and you saw massive outflow happening. But the actual reason was that leverage amplifies direction of price movement. What does it mean? In the crypto market, in the AI semiconductor space, and certain pockets in the US market, you are clearly seeing a lot of froth buildup that was happening. Now, when that cracks, no one knows. So after this crack has happened, now you can begin to link a lot of data points. There are a lot of participants who come in, use borrowed capital, and then even a modest move starts triggering massive liquidation. There was a report I was reading on X, I don't know the validity of it, that close to $19 billion were wiped out in the liquidation across crypto market just because of leverage. So this is the chart of Ethereum. Now I'll open up the chart of NASDAQ. Again, why did you see a single biggest drop in NASDAQ? Because there's a massive leverage in this market with respect to AI stocks, semiconductor space, and all other industries that are linked with it. You open up the chart of DAX, that is Germany market. It did not do relatively that well in the last 2-3 months, but still these markets are at all-time high. Any asset class that is at all-time high and when the sentiment worsens is the asset that is going to face more liquidation, especially if there is a factor of leverage in it. In the German market, there is not that much leverage still, but in NASDAQ, S&P 500, Bitcoin, Ethereum, some pockets of Chinese markets also, there is some bit of leverage that needs unwinding, especially when the sentiment does not work in your favor. So in S&P 500, although it's a culmination of 500 stocks, but primarily the earnings of this index is driven by AI. There was also a report that I was reading that 80% of gains in the US market is related to the AI and semiconductor industry. So it was a very narrow kind of a bull market that I'd also tweeted about. Whereas in India, the bull market is relatively wider. The earnings growth is across industries. Whereas in America, the earnings growth was limited only to the AI pocket space. That is 70 to 75% earnings. Does this mean this is beginning of a new crash? I don't know, and nobody can tell you that. But these violent shakeouts do happen in bull market, and that is what I'm going to term it. This is nothing but a shakeout in American markets. Eventually, over a period of time, when the insiders will feel that they have made enough on their short positions and they need to build back long positions, you will start seeing series of positive tweets coming out also. Again, this is a script that is getting repeated, and it's quite evident. If you follow stock markets closely, you know why these things are happening. Now I will explain why Indian markets will largely remain unaffected. See, first, too many people in Indian markets are caught up with Nifty 50, Bank Nifty, and Sensex. You have to move out of it, because while these indices are continuing to remain in a range, are relatively volatile, there is amazing movement happening in the broader market. A lot of sectors, a lot of industries are doing really, really well. So come out of Nifty, Sensex, Bank Nifty, and then look at the stocks within. Then you will realize that our market is actually not that weak. Yes, the headline indices in the first 6 months haven't done anything, and we have been more volatile. Whenever American markets have corrected, we have also significantly faced correction. It's only because FIIs pull out money, and because of that, index gets more volatile. Now, if you see, this could be a blessing in disguise for India. That is correction in global market. Will we correct because America is falling? Yes, some volatility will come about. But I think this would be an opportunity for foreign institutional investors to also diversify their holdings outside of the AI space, the semiconductor space, bitcoins. I'll come to gold and silver also, China, Hong Kong market, tech market in Hong Kong. It could be one of the reasons that could bring back some fund flow over time into India. I know majority of participants in India remain pessimistic because I quite frankly don't understand the reason, but there is a perception that Indian markets are overvalued, they are not going to do well, which I don't agree with it at all. Indian market, the economy is in a Goldilocks kind of a scenario. This means over time Indian markets are going to do well. And if I turn out to be wrong, I will come out and admit that my reading about the economy was completely wrong. But I feel Indian markets are ready to outperform once the global market volatility settles down. And it will settle down because the market itself will force the administration in the US to behave more responsibly. Mark my words, this is something that will come true soon, maybe in 15 days, 30 days, I don't know the time frame, but market itself will make the US administration behave in a more responsible way. There is no country today that can challenge China directly or indirectly also. China has worked so hard to put itself in such a position that majority of world economies in the world cannot survive by hurting China. And hats off to them because they have done all the hard work. If you look at our Indian market, this is the chart of Nifty 500. I'll just open up the chart of ETF, Nifty 500 ETF. We just haven't done anything over the last 12, 14 months, which means there is not massive position build-up in the market. Remember my earlier comment? Wherever there are gains, wherever there is greed, there is always leverage. Indian market is super light on leverage. This is going to work positively for us. Now compare that with gold. Compare that with silver. Can you see the extension that has happened? Extension of price. This is one of the reasons I had tweeted 2 days back that anybody who's investing in gold or silver in the very short term is going to have a lot of headaches going ahead. Not in terms of negative return, that is something I don't know, but mediocre returns are going to play out in these two pockets because there is a lot of extension. Because you're seeing a lot of participants coming in, opening up accounts just to buy gold and silver. It never works out this way. And this brings me to the point again that Indian markets, equity markets, are relatively cheaper when you compare it with gold, when you compare it with silver, when you compare it even with the American markets. The P ratio number that you keep hearing on television or social media, PE is a poor judge of valuation. That is how I would like to put it. PEG, that is PEG ratio, which is nothing but P divided by growth, that is a much better matrix. The reason why Indian markets don't look that attractive is because currently the growth is on the tepid side, which means the PEG ratio doesn't look quite attractive. The moment earnings start picking up, the PEG ratio will automatically put India back onto the map of investors. And that time will come, and which is why I feel the correction that has begun in the American market will turn out to be a blessing in disguise for Indian market. This is just a hypothesis of mine. It will be clear in the next 3-4 weeks whether I've been thinking on the right lines or not. Because like you, throughout this year, I've heard many times whenever volatility comes in the market that Indian markets are going to crash because FIIs are exiting. And what happens on the contrary is that there is some selling, Indian market absorb that selling and again move back to the levels from where they started correcting. So just map out all the headlines in this year. Every headline looked like it could bring about a massive correction in Indian market, and yet markets have been so resilient. You have to pay attention to the screen. Now, heading forward, let's say Monday, Tuesday, Wednesday, we see a lot of volatility. There are some sectors that are clearly telling you that risk reward remains in your favor in those pockets. First of all, in the last video, I discussed about two pockets, which were banks and metals. Look at what has happened in metals. Metal index has gone ahead and made a new all-time high. Similarly, if you look at bank Bs, it is very close to all-time high. Price bottomed out, and it has again started moving above the 50 DMA with strong wide range candles. So these two pockets will obviously be a point of focus for me. Whichever stocks or whichever ETFs I hold in this pocket, if I see a dip on Monday, Tuesday, Wednesday, I will cut some of my loss-making positions to increase my exposure in these sectors. The next couple of pockets that have been favorite for me are defense and capital market also. I will also make some adjustments in my portfolio so that I can take more exposure, make use of volatility, but I'll be buying only on the long side. I just don't care about short-term volatility. The two pockets that people were waiting for, autos and consumption, these are the two pockets which have recently seen a lot of fillip due to GST reforms. And again, if I see the correction coming in this pocket, then yes, of course, I will take some exposure, increase some exposures. There are some pockets that I'm clearly staying away from, which is the oil and energy space, which is the infrastructure space, which is the FMCG space also, because I think consumption, new age consumption, is doing a lot better. And the IT space, digital space, digital only couple of pockets, not companies that are in quick commerce or platform companies. They are again in a separate space, but these are the pockets that I'll be avoiding. There are some sub industries of the healthcare sector, that is hospitals. You have to look at it. Hospital space is buzzing. There are a lot of stocks in that space that is doing very well. Some specialty spaces I've spoken about, which is heart healthcare, eye healthcare, dental healthcare. Look at these pockets. These pockets, if you find a lot of volatility, you should look into it. How much we perform in market will also be a function of sentiment. Nothing can beat sentiment in the very short term when it comes to stock market. So don't have that expectation that you will have clean, smooth trend in the market. I think throughout this year, in my multiple videos, I've discussed this, that I see a smooth trend in the market only in 2026. And the closer we get to the year is when I'll be able to pinpoint in which quarter we can have that move. So anything for me in between would be a clear buying opportunity, clear accumulation opportunity. Of course, like you, I will also have to take losses in some positions to free up capital. Nobody has infinite amount of money, so capital will be freed in terms of taking losses in loss making positions, while giving preference to sectors like bank, finance, then metals, then I spoke about auto, consumption, some pockets of hospitals. So these are clearly pockets where a lot of momentum is building. Look at what PSU banks are doing. So there are a lot of pockets that are doing well. Indian market, in a way, is divided into a 50-50 kind of a scenario. The 50% of the market that comprises of the sectors that I spoke about is doing very well, whereas remaining 50% of the market gives you an illusion that the market is not healthy because indices are not going anywhere. Come out of indices, there is plenty of positive movement that is happening throughout the year. If you can, then run a scan about number of stocks that have given double digit return, higher double digit return, more than 50%. You'll be surprised to see the list that there is so many stocks that are doing well. So come out of index, look at sector themes. There is a lot of buzz going on in a lot of pockets in the economy. Pay attention to that. And these are themes that are here to stay despite of whatever happens in the US. There are a couple of things that you have to take note of. First, in the very short term, you will have to see where S&P 500 stabilizes. So how do you see that? A long-term base in S&P 500 is somewhere in this region. This is a long-term base. All right. Now, this is a huge drop that will cause a lot of problem in the global markets also. A much near-term base that I would be looking for is somewhere in this range. So first, I would like to see whether S&P 500 stabilizes in this zone or not. If it does not, it would mean that the correction in US market will get a lot more deeper. Remember, institutional investors, that is FIIs, or not leveraged, don't have massive positions built up in India. So I think relatively we'll be okay. So let's say American markets correct 10%, we'll probably correct 4 or 5%. That is my educated guess. I think in this leg we are going to outperform, and I still remain optimistic on equity market. And I feel that this particular correction, if it is a correction that is not a nasty one-way drop kind of correction, India will come out of it and will do relatively better than most asset classes. So my money is on the fact that Indian market is going to outperform US market. Indian market is going to outperform its Asian peers. Indian market is also going to outperform gold and silver. Again, I can be wrong, but that is my hypothesis for the next 6 odd months. And I'm positioned at least in the market in this particular way. All right. So I'll make another video when there is a need to make a video. I don't believe now in making a lot of videos because it just adds to the lot of noise that already exists in the market. I do give out 1 line or 2 line kind of a summary on my Twitter account. So do follow me on that. Every time that there is something that happens in the equity market, if I feel it is important, I will definitely come out and give you an update. So have a great weekend ahead. Take care and be safe.